Which retail giant is truly winning in the Philippines? Robinsons Retail Holdings, or Puregold Price Club? At first glance, Robinsons seems to hold all the cards. Almost 2,800 stores spanning groceries, drugstores, department stores, and specialty shops. Its gross margin glows at 24.6% on 210 billion pesos in sales, an elegant edge over Puregold's 18.7% on 242 billion pesos. More stores, higher profit per peso. What's not to admire? Yet underneath the surface, retail battles aren't won by the gross margin alone. They're decided after rent, payroll, logistics, depreciation, and the endless costs of growth. And here, Puregold outmaneuvers. Operating income reached 17.3 billion pesos, a robust 7.1% of sales, while Robinsons managed 10.4 billion pesos, around 4.9%. Puregold's net income lands at 11.3 billion pesos, a healthy 4.7% margin. Robinsons, despite its breadth, posts just 5.7 billion pesos to shareholders, a net margin closer to 3%. Despite superior gross profits, Robinsons simply keeps far less of what it earns. To be fair, Robinsons' numbers suffered from one-off distortions, but its normalized performance remains below Puregold's efficiency. The story grows more revealing when we turn to momentum. Puregold powered ahead with 10.6% sales growth, fueled both by rapid expansion and strong same-store sales. Robinsons grew more sedately, expanding at 5.7%, with slower gains at individual formats. Breadth isn't always speed. Puregold's engine proved both brisk and effective in translating growth into profits. Strength is further accentuated on the balance sheet. Puregold enters 2026 with a sturdier foundation, 200 billion pesos in assets, 103 billion pesos in equity, a cash pile of 29 billion pesos, and comfortable ratios. Robinsons, while large and diversified, ends the year more leveraged, less liquid, and less flexible, its cash reserves dwarfed and its debt-to-equity ratio elevated. Robinsons' financial asset complexity may offer upside, but also exposes it to greater risk and volatility. Cash flow cements Puregold's advantage. With 27.6 billion pesos in operating cash flow, it comfortably covers investments, dividends, and lease payments. Robinsons, though decent at 14.8 billion pesos, faces heavier demands, buybacks, debts, and an intricate financial asset structure. Dividend payouts tell a parallel story. Puregold's robust distributions derive from deep and reliable cash flow. Robinsons sustains its generous payout, but leans harder on balance sheet maneuvers and borrowings. Ultimately, Robinsons stands formidable, broad, profitable, and strategic. It boasts strong segments and higher margin formats. The challenge, however, lies in its financial baggage: more leverage, more complexity, and less resilience in volatile times. Puregold, by contrast, is simpler, more liquid, and cash-generative, with the capacity to absorb shocks and seize opportunities. In a market demanding both ambition and stability, Puregold's straightforward strength may be the advantage that matters most.